as we have people coming in. I think we're slowly getting into things. I am super excited to have Christopher Mirable here from Launchpad. It's probably prudent to say that Christopher is one of the top angels in the Northeast, heading Launchpad, which is one of the three largest angel groups here in Boston. And full disclosure here, I'm also a part and member of Launchpad for a good reason. So really great to have you here, Christopher. Tell us a little bit about, just to kind of like a soft entry, tell us a little bit about your background and what you usually invest in and what made you an angel.
Sure. Well, thanks for the chance to be here. I'm really pleased to, have something productive to do as we all sit at home and contemplate warming up leftovers for lunch. My background is enterprise software. That's really where I spent the bulk of my career before becoming a full-time angel. And it was actually an interesting run. It was sort of in the infrastructure software space. Middleware was the category back in the day. Before that, I spent some time as a corporate and securities lawyer and as a management consultant. And sort of exited the enterprise software world, just got a deal done right as the world was coming apart. In 2008, and decided to devote myself full time to working with startups, which was always the part of the company lifecycle I enjoyed the most. And got involved with Ham and Launchpad and running it together starting in the end of 2009. And Launchpad really focuses on Boston area companies that are science or technology based. We really focus on three main areas, enterprise B2B kinds of opportunities in the software space, health and life sciences, really we do medical device, diagnostic, healthcare IT, and digital health. And then the third bucket of things we look at is a fair amount of ed tech, some green tech, and then other miscellaneous kinds of things. The unifying theme for us is really relatively capital efficient businesses that are in the sort of need to have category rather than the nice to have. We don't do a lot of consumer, we don't do gaming, we don't do the cannabis industry, and we don't do consumer packaged goods or food technology. Although we do have a lot of people we can refer those kinds of deals to.
And in the last 20 years, Launchpad has deployed actually over $90 million, right? So one of the largest angel funds here in the Northeast.
Yeah, the group has been around for a long time and has been very active. We really kind of specialize in professional angels. And what I mean by that is angels who are in it for the long haul, do a lot of deals, have large portfolios, and really believe in a thoughtful approach and are dedicated to creating a professional experience for entrepreneurs in terms of respect, transparency, efficiency for their time, and good feedback. We also tend to prefer to lead the rounds that we're involved in, but every round we do is syndicated. And I think that 90 million has gone into about 105, maybe 110 companies total.
Oh, nice. Awesome. Yeah, good stuff. Let's dive into it. So today's theme is really how to secure angel funding when the recession hits. The GDP numbers came out just today, minus 4.8% in the first quarter. And as I read, actually, January, February were really good. Just the last 2 weeks, hit the quarter so hard that we're ending up at a minus 5%. They're predicting about a minus 30% GDP for the next quarter. So in the light of all of this, you wrote a blog post to startup entrepreneurs, don't give up your startup dream, which is sometimes easier said than done. Be optimistic, but also realistic. You want to share quickly about your most important thoughts about that?
Yeah, I mean, I really was trying to strike a note of hopefulness, Christian, and but also a note of practicality and realism. early stage investors, angels and VCs and micro VCs, we're still in business because we invest with long time horizons. The holding periods for the companies we work with typically transcend the business cycle. So if I'm investing in a company that's going to be, exitable in 7 or 8 years, the fact that we're in a recession right now is not super relevant in terms of the big scheme of things, but it does raise some practical issues in the near term. What I really said in the article was you can still raise money. It's going to be harder though, and your cost of capital is going to be a little higher. Valuations are going to be a little lower, is the more common way of saying that. And there are going to be some investor psychology hurdles that you're going to have to overcome. People just there's a perception of risk in this environment, and the two really big ones are just concerns about startups' ability to get customer attention and customer wallet share, because I think we are headed into very difficult economic times in the short term. And so, getting those logos, getting that customer traction, de-risking the business from sort of a go-to-market and, proof traction, dogs are eating the dog food kind of thing, it's just going to be harder. When you think about, the world in terms of sort of need to have and nice to have products, that line shifts in very difficult economic times, and people's definition of sort of what they really need is a lot tighter. Corporate budgets are tighter, and people's willingness to experiment is less. So one increased perception of risk is that, hey, any startup I invest in right now is going to have a harder time, just getting traction and momentum and getting some relief on their burn from customer revenue. The second issue for all early stage investors is where is the necessary growth capital going to come from down the road? Early stage investors really get the ball rolling and provide the first couple of rounds of funding, and then they'll typically continue to participate. But if a company's capital needs really start to grow, different kinds of investors become more appropriate. You'll see corporate strategics, and you'll see VCs taking a bigger role. And the VCs are really pulling back right now. A lot of the LPs are sort of signaling to the people who run funds they don't really want a capital call right now, and the funds are anticipating maybe harder or take longer to raise their next fund, so they're dragging out their current fund. And so the perceived future financing risk for us is greater as well. And so when you think about that, the demand to sort of jump into a risky startup is lower, and the perceived risk is higher. So the result on the valuation is really predictable. So that's really what I was trying to convey.
Thanks. And I think that was a really good article. If some people want to read it up, it's on starf.com. One of my takeaways from that was also, like, as an investment cycle is 7, 8, 10 years sometimes, the likelihood that you will hit a recession of that kind is pretty good anyway. So, right now this is your chance how you can prove it, but you're most likely not going to have just good times, and it's just about great timing. It is about the nimbleness and the agility. Can I ask you the biggest question? You mentioned that already. I think that everybody's on everybody's mind is can I still raise money in the next weeks and months?
Yeah, I mean, you absolutely can. I think that to the extent any raise requires the building of consensus, whether it's an investment committee or it's a group of angels, building consensus right now and overcoming a perception of risk is a little harder than normal, especially when you can't spend any face-to-face time with the team and the investors can't spend face-to-face time with each other. So I think it's going to be a little slower, but I think, we're seeing significant uptick in deal flow, and we're absolutely continuing to evaluate companies, but we're trying to set the expectation that it may take a little bit longer. And one of the reasons for that is that anyone who's been in the business for a while has a portfolio to feed and take care of, and Launchpad's no different. We've got 70 active companies, and many of them are going to be okay and or even helped by this, but many of them were just awkwardly ready to raise more money or are still in the burn phase. And so a lot of investors' top priority is protecting the money they already have put to work. And so follow-on rounds in the first half of this year are the higher priority than new investments. And then you've got the seasonal issues, Christian, which this is happening at an awkward time because typically I think May is going to be a slow month for this community. And typically May is a pretty big surge. People try to get deals done in May and June. And then in pretty much everywhere in the startup world, the summer's a little quieter from a fundraising perspective. So I think this is going to be a pretty back-end loaded year in terms of deals, is my guess. Okay. But I do think you can get things done.
Okay, by the way, as everybody joins in, use the Q&A button down there, put a couple of questions in, and we'll try to bring them up and answer them during the session. But feel encouraged to share your questions with us. What have you seen, Christopher, in terms of change of angel behavior? Would you say things might take a little longer? Consensus building, you said. Valuation, you said, might come down a little bit. Is there still an appetite to meet for angels, and how would you deal with that when everything is just non-personal and needs to be remote?
Angels are definitely active. There are a handful of sort of drags on sort of angel psychology. One is just sort of worrying about health and the news is pretty depressing right now. And so to the extent angel investing is sort of a part-time thing, there may be a little bit less time available for it. There's also, I think a lot of people have seen their net wealth go down a little bit with the stock market being up and down and all over the place. And there's also just sort of the perception that the asset class, I don't know whether the perception is correct, but the asset class is riskier in times like this. So there's a little bit of a drag on it. But for the most part, angels are in it for the long haul, and they're working out of pools of money that it's not bread money, it's not rent money, it's money that it's an allocation of funds that's been set aside for high risk, high return activities. And most angels who are experienced recognize that investing through the dips, through the troughs is one of the smartest things you can do. And Launchpad had some of its best years. We were born in the meltdown after the .com, that group formed in 2000. And some of our best investments came out of the 08, 09, 2010 period. And so I'll be really disappointed if we don't meet some great entrepreneurs and get some deals done this year. I really fully expect that we will.
So it's not just a myth that actually those are the best years to harvest, because you had to go through the hardship of starting from scratch and working with little money. Can I ask you, did you see a change in investor preferences? So in terms of industries or business cases or teams, any kind of trends here already?
Well, I think that there are some psychological factors. Obviously, businesses that directly relate to pandemic or remote work, those kinds of things are going to be very much on trend and in favor. But I think in difficult times, there's a little bit of a flight to experienced entrepreneurs who've been through downturns before. Probably get a little bit of credit for that relative to entrepreneurs who haven't. And I think businesses, there's an emphasis on capital efficiency. When the investment thesis is, we'll get this thing rolling and then we'll raise a ton of money a bunch of times, those businesses are relatively, except for the very largest funds, those businesses are a little bit less attractive. Businesses that have good margins, good unit economics, are relatively revenue forward, tend to be more appealing. But for the most part, angel investing it's a pretty simple concept. You're looking for great teams working on problems that matter to a large enough group of people to make a good market opportunity. And your holding periods are going to be pretty long. So if you're working with quality people and the problem matters to enough folks, those are the fundamentals. And I'll invest in that hypothesis at any point in the macroeconomic cycle.
Okay, I think it's probably fair to say that the more experienced the angel is, they probably see this as an opportunity to invest and still go on, because they know that there could be a really good environment to invest and find out the great ideas that go through rough times.
Yeah, I mean, I'm really careful to avoid, sort of the mistake that Tim Draper made of talking about to his LPs about how, oh, it's great, we're going to fleece all the entrepreneurs, because that's not really what it's about. The pressure, the downward pressure on valuations isn't just that people are trying to get a good deal. It's that the risk return profile has changed, and the ability to get a deal syndicated and the concern about future financing as it affects and relates to post money. These are all very real issues. This is not opportunism. These are real economic issues. But that said, right now the market's never been better for co-founders and hiring talent. It's a little bit like being in grad school during a recession. If you're in the product building phase anyway, who cares? I mean, just put your head down, hire some really good talent, and crank it out. And by the time you're sort of ready to ship and go to market, or your healthcare laboratory experiment is ready for regulatory review, the economy's going to change. So all is not lost here. There's a lot of hardship, and there's a lot of suffering, and the news is terrible out there. And my sincerest condolences go out to anyone who's been touched by this in their personal life. And we're going to have some job loss. We're going to have some hard times. Our portfolio has already laid off a bunch of people across the different companies, but there's a renewal associated with these kinds of downturns. I mean, I'm embarrassed how many downturns I've lived through. I'm getting old now, Christian, but things come back. They come back in many ways stronger and better and cleaner. And so we're going to get through this.
By the way, just to share this adventure lane, we also have a bunch of companies that had to let people go, and probably in the next couple of days, we're going to put out a newsletter with more job offers than we ever had. So there's a great opportunity here. Now, let's talk a little bit about tactics and tactical. How do I approach angels in an environment that is, totally remote? How would you do that? What kind of advice would you give?
Yeah, the advice is always sort of the same, which is that it's tough to break through with cold calling, and it's not, that issue is not an issue of elitism. It's more an issue of signal noise, and if you can find someone who's willing to invest a little of their social capital on your behalf, that creates additional pressure on the investor, and it also sends a really valuable signal that that you've got the people skills to make that request happen, and that you have got someone who's willing to vouch for you. So I think the basic advice is maybe unchanged, if not amplified, that in a time when there's a lot going on, there's a lot of clutter, and everyone's in the process of reinvesting their business, breaking through by using your basic networking skills, just the sort of 3 golden questions, right? Can I get any advice from you? Can you think of anybody it would be good for me to talk to about this? And would you be willing to introduce me to that person, right? Just processing that. And if you're talking to someone and I say, hey, Christian, do you know anybody it would be good for me to talk to? You say, gee, Christopher, I don't know anything about underwater basket weaving. My next, I don't say thank you. I say, well, do you know anybody who might know anybody, right? Work those connections, and find people who are willing to just say, hey, I got something for you to take a look at. And I think that's particularly true now, especially when a whole category of meetings is missing, like just bumping into each other at events. There's a whole piece of serendipity that's missing right now. We're not mingling and bumping into each other and having these happy accidents and surprise connections. So you're going to have to do it all manually. And
So that is really
email.
being mindful and thinking of this as a little bit even like a campaign, like who do I address to, which channel? I mean, Asad was here asking about how do I deal with this when I don't have a face-to-face meeting? Right now, it is not face-to-face, but on the other hand, angels are at home and they have a little bit more time, right?
Yeah, in a lot of ways. I mean, nobody's wasting 2 hours or more in the car every day right now or on the public transit. So in some ways, the bar to getting a meeting is lower. When in normal times, an entrepreneur wants to meet with you, it's really better to meet face to face. And so you're kind of the bars that you're like, am I gonna take the time to drive and park and deal with this and meet with this person, or I'll just give them one of the slots in my office hours or whatever. But now the bar is relatively low. This situation has sort of normalized interacting by video, and interacting by video is reasonably proximate. It's decent. It's a decent way to do it. So ironically, it's I think easier to get in meetings with investors right now than in normal times.
Christopher, let's talk a little bit about the different stages that different companies are seeking for funding. Do you think right now this current situation is different for a super early stage, concept only, no revenue, no MVP, versus a little farther, some first revenue versus a bit more proven go-to-market and some revenue? Would you say, do you have any insights on that and any tips maybe for those different stages?
It's hard to generalize because every company situation is a little bit different. I think that one of the things that's hard here, and it hits the really early stuff disproportionately, is that right now, when things are tough and there's kind of a defensive mentality and a flight to cash, and people are worried about the health of their family, and they're worried about the economy, and maybe their significant other lost their job, or their kid getting out of college can't get a job. There's a sort of optimistic, speculative, buoyant element, suspension of belief that kind of happens with all early stage investing. And that piece is definitely less in hard times. And that kind of willing suspension of disbelief is particularly important at the pre-revenue stage, when it's truly speculative. And I typically, when you're talking about really, really early seed, pre-seed kind of stage, what you typically see with those investors is some kind of a strong affiliation to the company. Either it's the investor knows the founder, or they know the market really well, or they really know the technology and they have a real connection. And in situations like that, where you've got an investor who's really fits like a glove, you're probably still gonna be able to get that investor to connect with you. You're not gonna get the tourist investor at that stage. The speculative investor, they're kind of pull back their horns. When a business has a little revenue, though, it's de-risked. The problem is that's a double-edged sword, because if it's the kind of revenue there's going to be more of in a global pandemic, then they're made in the shade. But if it's the kind of revenue where they had a few hits and then now all of a sudden their sales cycle's gone way out, and their top of their funnel's really disappearing and all that kind of stuff, then they may need to pivot to prove that the revenue is going to keep coming in. So I think it's hard to generalize, but I think that the removal of the speculative optimism driver probably hits the earliest companies disproportionately hard relative to the ones that are in market.
And maybe to provide a little bit of context, like all the companies that I'm seeking, I find the ones that are pre-revenue and a little earlier stage usually have a little bit of a harder time right now than the ones that have at least a good foundation. At least the first 6 weeks that I'm seeing.
There are offsets, right? I mean, when you're pre-revenue, you're selling on the dream rather than the reality. So that can help a little bit. And if you're so early that you're still developing your product and you've got a year before you're really going to be going to market anyway, the recession is a good time to be doing that, right? Because the hiring market's good. So it depends a little bit on the situation. There are some puts and takes, but broadly speaking, my gut instinct is in line with yours, that it is a little harder on the really early companies.
Yeah. Ignacio asked us, are there any particular industries that are not getting any attention from investors? Or I would actually rephrase this. Are there industries right now that you see that are getting a lot of attention, and then industries that are definitely not getting as much as attention as maybe as before?
Well, I mean, if you want to sort of analogize, right, you can think about every product as either oxygen, aspirin, or jewelry. Oxygen being necessary for survival, aspirin being pain relief, and jewelry, being a nice to have. Clearly, the demand for luxury and unnecessary items is less, and so the more urgent the value prop of a product is, the easier it is to get funded and the more interest there's going to be. And then obviously anything that relates to the current situation, there's a lot of interest in the intersection between technology and health right now, contract tracing, assays and diagnostic kind of stuff is very hot. You and I were talking before the session got started about how you often see an interest in outsourcing and robotics and automation and things like that. So I think there will be some lasting changes from this. But in terms of like forming a really big uber galactic, post-COVID thesis, I think it's a little early, honestly. Anybody who tells you that they've got it all figured out and they have a really big, strong, well thought out thesis for after this is over, I think they're pulling your leg a little bit. I just think it's a little too early.
Another tactical question here around what kind of metrics during this phase, which is definitely you a very specific environment, which metrics should you have in mind that you think people are definitely interested in? And the other one is what are the things that I should not miss covering in my pitch? So I came across a couple of pitches that, for example, did not mention COVID at all, and I was like, how can you not mention that? That definitely has an impact on you. What's your take on that?
The metrics that are going to let the investor gauge the relative priority of your product and your value prop compared to the other things that your customers are spending money on are going to be important. So maybe it's renewals, although that metric can take a while because most are on an annual cycle. Sales cycle, shorter sales cycles showing that there's relatively good momentum and pass through, cost of customer acquisition, things that show that the business is naturally buoyant. Business models where they basically boil down to raising a ton of money and just brute force, bulldozing your way into a market. Businesses like that represent a fair amount of risk because is there going to be enough money to see that strategy through is a big question. And in hard times, people are just a little bit more ingrained in their habits and a little bit less likely to change tools and change habits and change things that are working or make speculative expenditures. So the businesses that can kind of prove that they're still really relevant and that they've got good unit economics and they're having a reasonably short sales cycle and a reasonable cost of customer acquisition are going to be the businesses that are going to be worth taking a chance on while we're in a period of such uncertainty.
Before we go through the different questions here, we answered a couple of them, but the ones that are still open, I wanted to ask you around timing right now. So if you had to choose between raising now or in 3 to 6 months, short answer, what would be your tip? Well,
that's a little bit of a false choice, right? Because I think raising right this second's hard, but beginning the relationships is not, and it's a good thing to do. I think that the seasonality really complicates this, as we were talking about before. Um, I think if you are hoping to have money in 6 months, it's not a bad thing to start going out there and asking for advice and for intros and for feedback on your plan. But if you it's going to be hard, frankly, to get deals closed unless they were already pretty close to full and had a lot of momentum. I think it's going to be hard to get complete financings started and finished in the May, June, July timeframe. July and August tend to be pretty quiet times in the startup world globally. I mean, not just in Boston, but in San Francisco and Miami and everywhere else. So it's the simple answer is 6 months is better, but probably getting started now and using this time to make those connections and do that networking, get that feedback.
So is the prudent answer, like, it's going to probably take longer even than you thought? That's what's usually the case, but even in this circumstances, even longer. So start today to plant your seeds to harvest a little later.
Yeah, I think so.
And the other thing is, if you had to choose between a smaller round, like maybe a bridge, which maybe can be done with existing investors, or really going for a bigger priced round, and you really have the choice, you think like, well, do I go for this or do I go for that? I know that depends pretty much on the situation in the company, but let's say they feel reasonably comfortable they can do a smaller round, but they actually wanted to do a bigger round. Any advice here?
There are some operational implications with all of this. I think companies are, not looking to incur a lot of expense, not signing big leases, maybe not making as many hires as they might, maybe conducting fewer go-to-market experiments in parallel, maybe doing them more sequentially. Absolutely. Nobody wants to go out with a big target and try to get a big round together and have it fail and get overshopped and it just loses momentum. And then your original soft circles that you could easily have closed on have sort of flaked. And so I think that putting together leaner plans with very specific use of proceeds, saying, we're going to conduct a very focused experiment on the go-to-market, and this is exactly how we're going to use the money, and this is how we're going to de-risk the company's result. This is what we're going to know. I think that's the safer course to sort of bite away at it. And one of the issues, one of the arguments against raising a ton of money right now is, there's no question valuations will, improve in the future relative to where they're going to be in the near term. So to the extent you could get by on a little bit less money and progress the company a little bit further and run a little leaner and a little tighter on expenses, that's probably a pretty good strategy.
Okay. No, makes sense. Now, looking for a couple of short answers to our questions here. Jeff White's asked, if you were planning on fundraising with a concept stage pitch, should you put some more into a proof of concept or actual product development before pitching? Or is there still appetite for an opportunistic concept?
It's going to depend a little bit on the situation and the investor. If it's really, really relevant to the current market moment, there could be a bit of appetite, but the investors who invest at that stage really have an affiliation to the technology or to the market or to the founders. As a general matter, most mainstream angels, like a lot of the launchpad people, they're investing really right at the point of market entry and not taking on a tremendous amount of technology risk outside of the healthcare space. So deal's always going to be more attractive if there's a prototype and some of the technical risk has been taken out. And if there's still a lot of technical risk in the company, then you're definitely working with a subset of investors who are kind of really passionate and knowledgeable about your particular space.
Jeff had a questions around solo founders versus teams, and was asking whether angels maybe look differently as a solo founder setup versus a team setup.
Yeah, angels tend to shy away from solo founders, just knowing how hard it is, and what a broad range of skills are really required to get a startup going. And particularly when there's an easier hiring environment, like right now, it's an even bigger yellow flag. Um, I would say that in normal times, being a solo founder is a little bit of a question mark or a concern. And in a market like this, where there's lots of really great people getting laid off, it's an even bigger concern.
Okay. Paul Hay is asking, O'Hara is asking about why should I even go out for money right now when I see that the terms are not really good. I mean, there's the need for money, but it seems if you can stretch it a little later, you probably would go for, if you don't have to raise money, then you wouldn't, right?
Yeah. Why should you go out for money right now? Because you need the money. If you don't need the money, don't go out. You know,
Yeah.
the last thing you want to do is get pesky investors involved in your business. So if you can do it without raising money, God bless you, go for it.
Okay.
But you know, there certainly are a lot of people competing for less funds right now. So if you can wait, you should wait.
You touched on that before. Nir had a question around, now there's the warm connection obstacle right now when you're stuck at home. You mentioned that a little bit before. One or two tips how to overcome that burden that you would say. What could replace this in a time where everybody's sitting at home?
I think in a virtual world, LinkedIn is one of your best tools. I've never been a premium subscriber on LinkedIn, so I don't know what it can do for you. But just being a free, freemium LinkedIn subscriber, just taking the time to do the research and figure out, what a particular investor has invested in, and whether you have any connections, and maybe which of the people in common is the best path to go in. And then, saying to that bridge person, hey, listen, I'm trying to get a hold of Christian. It looks like you know him. Here's what I want from him. If I were to give you a note, would you be willing to reach out on my behalf? Here's the message I'd like you to convey. And most people, I'll say in situations like that, when I'm the go-between, if I say, yeah, I know that person well enough that I think I could do that, I'd be willing to do that for you. But if I feel like I don't, I say to them, how many other options do you have? Are you sure I'm the best route? Because I don't know that person that well. I can't figure out where I even met them. So we have the time now. We're all sitting at home in front of our laptops. So do the legwork, do the research, look at the different pathways on LinkedIn to get to somebody, and then plan your attack and put together a nice customized note that makes the case. And I think the other thing that really turns people off is outreaches that just begin with, hey, I've got this thing and I'm looking for money, but if you say, hey, I'm working on this problem space and I know that you have some experience in there and I'd like to talk to you about my idea and get a little bit of feedback and some advice. It won't take more than 10 minutes. Then you think to yourself, okay, this sounds like this is manageable. This isn't just yet another cold call asking for money. And this person's come to me for a specific reason, right? There's a big difference between saying, I want to go to the senior prom versus I want to go to the senior prom with you because, right? So taking the time to go, this is the problem space I'm working in, and I looked at you, it looks like you've done some investments in that area, or you have some experience in that area, and I would love to pick your brain. I only need 10 minutes of your time. Investors are so much more likely to engage with that than they are with, I've got the Uber of dog food and I'm gonna, I'm on the other side of the continent and it's the greatest thing. And I've got all these metrics and all these endorsements from strangers I've never heard of. It's just crap. Nobody responds to that.
Yeah. Well said. I think one little tip is if you ask somebody for an introduction, make it really easy for that person, pre-write that email, think in their shoes. make it super easy. And I can tell you, you will probably be blessed with quite a bit of success because, these people also have a very restricted time. Yeah.
Mm-hmm.
Fritz was talking about, Christopher mentioned he can refer retail CPG companies to angels that focus on this asset class. Could he mention some of these retail lifestyle angels today? I don't know. That might not be the forum here right now.
Well, I would encourage people in the CPG food tech area to take a look at Branch Ventures. They're terrific investors and good friends of mine. And Branch Ventures is where Launchpad refers its food and CPG deals too.
Fritz is in lifestyle fashion brand.
Lifestyle fashion's tougher. There's not a huge depth of skill in that space. The best advice I would give to Fritz is the same advice I would give to other investors other entrepreneurs trying to find specialty investors is try to look for analogous companies, fashion plates or there was a company that had to do with like rental fashion wear, but in any event, try to find analogous companies that are somewhat in the same space. Network as a CEO to the founders of that. And when you build a little bit of a rapport, say, hey, I'm trying to find investors. Did you have any investors who you worked with, who you thought were particularly good? And chances are, if they invested in a company similar to yours, they may be open to investing in your company. So fellow CEOs and companies in the same space is the best hack for finding potentially interested investors.
Okay, cool. And I saw Lucia Maffei from the Boston Business Journal ask us a question. Lucia, where we answered that question. If you did not get the answer to that, we will happily share the recording of this session. An interesting one here from Eric. What policies or programs should state and federal governments be considering to spur early stage investing in startups beside investor tax credits?
Yeah. What I will say to the Boston Business Journal is just drop me an email or Christopher at launchpadventuregroup.com, and I'm happy to talk to you about how COVID is changing networking if you want separately. And the question was, what tax and public policies?
What policies or programs should state and federal governments be considering to spur early stage investing in startups?
Yeah, so this is something we're thinking a lot about at the Angel Capital Association and at the National Venture Capital Association. Sort of what are the and the PPP and the economic injury programs are good in concept. There have been some issues with implementation. They help a lot. One of the anything that kind of incentivizes maintaining payroll. Massachusetts it would be helpful if they would get their angel tax credit pushed through. But to be honest, it's not an industry that I think really needs or wants or deserves handouts. We have the 1202 eligibility for capital gains if a company works out well, and we have the ability to offset against ordinary income under 1244. So I think that the R&D tax credit and being able to apply that to payroll with fewer restrictions would be very helpful. Cleaning up 1202 so that you can invest in LLCs and you can tack the holding period of convertible notes. There's a lot of small stuff that should be done at the federal level. At the state level, angel tax credit would be I think a stimulative one. But it's hard to know, like even things like opportunity zones. I mean, geography is totally out the window right now because nobody's meeting, the whole co-working space stuff. It's a really unusual time right now. I'd have to think about that one. I can't answer that question very well, to be honest with you.
Okay, good. And then last question, we have plenty more, but I think we're coming to an end. Mike was asking, he has a B2B startup in channel sales, tech and ad tech. And, consistently hears that sales or ad tech is not really interesting for many early stage investors. They bootstrapped towards $1 million ARR, and he's asking, is there any advice that how do you come to investor discussions when you're in a field that is maybe not as attractive to a couple of early stage investors?
Well, first of all, ad tech and sales tech are different, right? And I think investors have more interest in sales productivity and sales enablement than they do in pure ad tech, at least in this part of the world. That said, that's a really competitive space. It's a big market, and enterprises spend a lot of money on sales training, sales enablement, sales productivity tools, because that's where the tool meets the grindstone. So that's a big and attractive, although quite competitive market. Ad tech is a tough one, simply because right now ad spending is down, and I mean that's an area that's going to get pretty badly hit in the short term. I also think that that is probably the single most helpful thing you could do is prove that the value prop is durable. Most investors just look at MarTech and ad tech and they just see fads. Something's hot for a little while and it works and it gets results for a while, and then it gets copied or it loses its effectiveness, and marketers are on to another different tool as fast as they came in the first place. So proving that your value prop is durable and will deliver lasting results and customer renewals over a long period of time is probably one of the best things you could do to get investor interest in your ad tech.
Cool, good stuff. I mean, I'm really happy to say we got through a lot of questions at the beginning, and we have even answered the audience questions to about 50%. Sorry that there wasn't enough time to get to all of them. Christopher, thank you very much. I think you had a couple of really good gold nuggets here. Right now, still a good time to raise, or it is still a time to raise. However, it's, I think, to acknowledge the different circumstances and choose your different tactics and how you go about it. If anything, be a bit more mindful about the other side and what they want to hear and what they're seeking out. Thank you. Yep. If people want to get in touch with you or Launchpad, how does that work?
So Launchpad's easy. There's a whole page for entrepreneurs right on our website, Launchpad Venture Group. I can move over this way, launchpadventuregroup.com, and just drop us a note, fill out a profile. We would absolutely love to hear from you. You can DM me on Twitter at @Mirabile. I'm reachable on LinkedIn. And as I mentioned, Christopher at launchpadventuregroup.com. If you want to drop me an email, just remind me where we connected, and I'm happy to talk to the BBJ or anybody on that. Just a reminder that article that talks about not giving up your dream and the realities of raising right now, you can find that on Seraph, Seraph-investor.com/compass, or just go to Seraph Investor, just go to the blog and look for the article on Don't Give Up Your Entrepreneurial Dream. There's some good thoughts in there.
Awesome. And then we at Venture Lane, we have a little bit more programming coming in the next couple of days and weeks, just for everybody to know. So we have capture massive lead generation through video with John Pujak. So that'll be interesting. We thought about, right now, this is for a lot of companies and a lot of people, the way to connect. So that will be, John is an expert in that field, and he'll tell us a bit about the playbook and how to set this up. And then Lily Lehman from Underscore actually has an interesting perspective on how investors can actually help restart your growth, and looking into that perspective. So Lily is great. She's a partner at Underscore, a really great VC here too. Christopher, thank you very much for your time and for your effort, for your wisdom.
Hey, I'm going to try to answer a couple of these questions. So I'll mute myself and turn off my video, but I'll stay for another 5 minutes and just try to answer a couple of the questions. If anybody wants to stick around, don't shut it down. There's some written Q&A.
Beautiful, and I think you can do the written one, the written answers. Awesome, good stuff. Well, thank you so much for offering that. That's really kind.
All right.
So if you have questions, that's still the possibility down here, Q&A. Christopher went on mute. answering as many questions in written form in the Q&A right now. So thanks for joining us. If you have questions, go to the Q&A. If not, we hope to see you in one of our next Venture Lane webinars. Always, by the way, check it out on the venturelane.com. This is our program and our calendar where you can see what we're offering. So we're usually targeting our content towards early stage tech startups, and try to help navigate through the current period of time and the current changed environment. Thank you.